Hello and welcome to the Scan the Markets webinar with myself, David Madden. I just want to ensure that everyone can see me okay and hear me okay before I look to kick off the webinar. So I'll just wait until a few people reply to say that they can see the script, they can see and hear me okay, and then I'll look to kick things off. I just want to apologize in advance. I have a bit of a cold, so I've been kind of sneezing all day. So I'll try and keep that to a minimum for the webinar. Yes, all good, excellent. That's the kind of replies you want to be hearing. So if anybody just joined, all good, excellent, excellent. Everyone's quickly replying, saying that they can hear me okay, fantastic. I will look to kick things off. So what you should, what you should be able to see on your screen now is a green slide, and up the top left is the FX Pays logo, and then on the bottom left, what it states is trading emerging product carries a high level of risk. Can everyone see that? Okay. Hopefully you can see that, and I'll look to just move on. Slideshow. The next slide says the same thing. The FX Pays logo is up the top left, and then the bottom left is trading in margin products carries a high level of risk. What this essentially means is that anything that I say or cover in the webinar is only my own personal thoughts, views, and opinions. It should not be taken as explicit trading or investment advice, as it certainly should not be considered to be the opinion of FX Pays. Now, to introduce myself, my name is David Madden. I work as a market analyst for Equity Capital. I'm based in London, and Equity Capital, of course, is one of the many companies within the equity group, including FX Pays. So the first thing I'll start off with is euro-dollar. So we've seen a huge amount of volatility in the currency markets this week. To be honest, for a change, the currency markets seem to have actually overshadowed the stock markets this week. The price action, what's been going on? On one hand, we've had a very strong US dollar. Why is this? Well, we've seen a surge in US government bond yields. US government bond yields in the last 24 hours recently topped 4%, its highest level in 14 years. To put it simply, when bond yields are rising, that's a sign that bond traders anticipate further interest rate hikes. When bond yields falling, when bond yields fall, that generally means that traders anticipate a decline in interest rates. Just one moment. Apologies about that. So when yields are rising, that typically means traders anticipate further rate hikes. So the rally we saw in the US government bond yields, particularly the US 10-year yield, indicated that the markets are pricing in more rate hikes from the Federal Reserve, and in turn, we saw a sharp move to the upside in the US dollar. When we saw a move to the upside in the US dollar, we saw a move to the downside in euro dollar. As we can see here, the currency pair fell aggressively during the week. In fact, it fell to a new 20-year low. So it really highlights how bearish the market sentiment is. when the currency pair falls to a 20-year low. That being said, we have seen a bit of a rebound in the past, 24 to 48 hours. We've managed to bounce back a fairly sizable amount. In fact, we're not back above these two simple moving averages. This here, by the way, is the 20-period moving average. This here, by the way, is the 50-period moving average. And this here, by the way, is the 100-period moving average. And I'm looking at on the 4-hour charts. It's the time period I'm using. So we've had a fairly decent rebound in the past 24 to 48 hours. Looking at the RSI, the Relative Strength Index, which essentially it's kind of like an elastic band. It kind of almost measures how far stretched a market is in one direction or the other. The RSI is moving higher, which indicates the price bias is to the upside. And this histogram here shows that the bars are in positive territory. And when the bars are in positive territory, that indicates that the bulls or the buyers are in control. So the price is moving higher, the RSI is moving higher, momentum is in positive territory. This all speaks to bullish sentiment in the near term. So if this short-term upward move continues, where can we target? We could head up towards 0 spot 99.06, and a break beyond that could see it up towards 0 spot 99.67. Now, even though the short-term trend is higher, we can't ignore the fact that the much longer-term trend is lower. In fact, only a few days ago, it dropped to a 20-year low. So that really speaks to how bearish the longer-term trend is. So if we do see a continuation of this longer-term trend, where can we target? If we do fall from here, we could have to retest 0 spot 96.35, and a break below that could see us back down towards 0 spot 95.35. That could be, these are the areas to watch out for to the downside. And of course, if we do break below 0 spot 95.35, we then be creating a new 20-year low, and then we could be looking back down towards 0 spot 95.00, and then a break below that could see us back down towards 0 spot 94.00. So one of the kind of other currency pairs that has a lot of volatility this week has been the British pound, for a couple of reasons. Essentially, the UK economy the British pound has seen a lot of volatility in the past 5 or 6 days. A few weeks ago, it was announced by the new UK government that they're going to spend, anything from 100 billion to 150 billion on an energy support scheme, which would mean ramping up government borrowing. Last Friday, so 6 days ago, we saw a raft of tax cuts were announced in the UK's mini budget, and it was about 45 billion pounds worth of tax cuts were announced. The aim is to cut tax across the board, and with that, in theory, that'll stimulate growth and get the economy properly moving again. That's the objective. That's the theory. And let's see how well it works in practice. But when you announce tax cuts to the tune of 45 billion, that means you need to either cut spending elsewhere, or in this case, borrow 45 billion to make up the difference. So the UK in the last few weeks has announced essentially announced it's going to borrow a huge sum of money. It could be 150 billion pounds. It could be 200 billion pounds. And with this, what we have seen is a huge sell-off in the British pound. As traders are concerned, what we could see is that the UK government struggling to actually pay the UK government could potentially struggle to pay its debts, to service its debts. Now, that isn't a very realistic possibility, but it's those kind of creeping fears have been coming into the British pound this week. Hence why we saw a sharp loss in GBP USD, partially because of the overall rally in the US dollar, but also we have seen brutal losses in the British pound across the board. The pound lost against the Swiss franc, the euro, the Australian dollar, the Canadian dollar, a whole raft of currencies. So this week, pound dollar fell to its lowest level on record, which really, really underlines how bearish sentiment is. If the currency pair has fallen to an all-time low. Now, granted, in the past few days, we have seen a bit of a rebound, so things are looking a bit better in that regard. But similar to the euro dollar currency, similar to the euro dollar chart, we can see that the market is rebounding. We've seen a higher high, higher low, higher high, higher low, and a higher high. In fact, we're back above these two simple moving averages, the 20-period moving average and the 50-period moving average. Similar situation with the RSI, it's moving higher here. The MACD indicator shows us that momentum is in positive territory, implying the bulls are in control. So with that, these two indicators speak of bullish sentiment. If we do see a continuation of this short-term upward move in pound dollar, where could we target? Well, I'll be looking up towards 1 spot 1243, and right beyond that, could see a target 1 spot 1363. Now, even though the short-term trend is higher, let's not forget the much longer-term trend for the currency pair is lower. If we do see a move to the downside in pound dollar, where can we target? Well, I'll be looking down towards 1 spot 0877, and a break below that could see us back down towards 1 spot 0760. What I'm actually going to do now is see if I can feel myself probably sneezing a bit too much. What I'm actually going to do is I'm going to knock off my camera, but I will turn on the camera later on. So the common theme of the week has been a strong US dollar, and then on top of that, a very, very weak British pound and a pretty weak euro as well. The strength of the US dollar has also rippled out to other markets, most notably gold. During the week, gold dropped to a 2-year low. Why is this? Well, gold, like other commodities, is traded in US dollars. And recently, there's been a strong inverse relationship between the gold market and the US dollar. So when the dollar has been strong, we've seen a weak gold market. And whenever we've seen a weak US dollar, gold has typically rallied. Not always. It's a relationship that doesn't always hold, but recently it's been holding a lot, if that makes sense. So I mentioned a moment ago how pound dollar was at an all-time low and euro dollar was at a 20-year low. Therefore, the US dollar itself was very, very strong. So it's no surprise when we've seen the US dollar index at a 20-year high, gold falls to a 2-year low. So that kind of longer-term trend for gold is lower. That being said, we have seen a pullback in the US dollar in the past 24 to 48 hours. With that, we've seen a rebound in gold. We can see here that gold is back above these two simple moving averages, the 20-period moving average and the 50-period moving average. Looking at the RSI, it's moving higher, indicating the price bias is to the upside. Looking at the MACD indicator, we can see that momentum is firmly in positive territory, implying that the bulls are in control. So if we do see a continuation of the short-term upward move in gold, where can we target? Well, I've been looking up towards this zone here in around 1674. We can see there's a few kind of peaks in around this region here. At the upper end would be kind of 1679 down towards 1674. That kind of $5 zone there on a few occasions acted nicely as resistance. So it's a possibility it could act as resistance zone yet again. Notice how this price action here of 1697 also coincides with the 100-period moving average. And you can see here that it wasn't perfectly, but broadly, this general zone acts as resistance here in mid-September. So it's a possibility that the 100-period moving average might act as resistance once again, because broadly speaking, it acts as resistance point up here, and also it is essentially two price points overlapping. On one hand, it's the resistance zone along here, and on the other hand, it's the moving average. So with that could indicate that price area around 1679, 1680 thereabouts is going to become potentially more important or more significant. Why is this? Well, some people out there don't pay any attention to moving averages, but they just focus on support and resistance zones. So the people who are interested in support and resistance will have probably clocked that 1679 has been a resistance zone. Other people out there don't pay any attention to support and resistance zones, or don't pay much attention. But what they do pay attention to is moving averages. So they're keeping an eye on the moving average, and they've observed that broadly speaking, the moving average, broadly speaking, actually has resistance here in mid-September. And that moving average currently sits around 1679. So when you combine those two, the moving average crowd and the support and resistance crowd together, that's what can make a metric or a price point more significant. I hope that makes sense. If we do manage to break above this zone here, where can we target? Well, I'm looking for this peak here around 1688, this spike here. That also coincides with this consolidation zone here around 1690. And then, of course, if it clears 1690, the next big level to watch out for will, of course, be 1700. What's also been going on in the markets? Well, I talked about how bond yields, in particular US government bond yields, have been on the rise. Now, if bond yields are rising recently, that's typically sparked a sell-off in stock markets. Why is this? Well, people are asking themselves, why would I hold shares that, say, for example, are constituents of the S&P 500, when from a government bond, I can get a yield of around 3.8 or 4%, or a return, if you will, of 3.8 or 4%. So when yields are rising, that makes some people, some investors sit up and pay attention to the bond market and go, oh, rather than having all my money or a huge portion of my money tied up in stocks, perhaps I should have some of my money tied up in government bonds and therefore sell stocks and in turn pour the money into bonds. On top of that, what also means is whenever you see a rise in bond yields, as I mentioned a few minutes ago, that typically means the bond market and bond traders are pricing in more interest rate hikes, i.e. the cost of borrowing will go up, is likely to go up. If borrowing costs go up, that means all the companies that are constituents of the S&P 500, they'll probably have to pay more borrowing costs. Therefore, that chips away at their profitability. Chipping away at the profitability means less, a smaller profit margin means overall net profit declines. So it works both ways, from an investment point of view and from a practical point of view. So when yields are rising, that has typically sparked sell-offs in stock markets. So for anyone out there who trades the big indices like the S&P 500 or the US 500 or the NASDAQ 100, the UT 100, keep an eye what's going on with the US 10-year yield. When you've seen spikes in the US 10-year yield, that's often when you've seen large declines in those indices. So I mentioned a few minutes ago how early this week the US 10-year yield hit a 14-year high. It traded above 4%. That was a big deal. What did we see corresponding with that? We saw the US 500 fall to its lowest level in almost 2 years. So a multi-year high in yields translates to a multi-year low in stocks. Once again, an inverse relationship is at play here. Look at the big picture view. Granted, we rebounded somewhat, but the rebound itself wasn't particularly impressive. It went above the 20-period moving average. It didn't even get close to retesting the 50-period moving average before it turned lower once again. Looking at the MACD indicator, momentum is in positive territory, but there's a clear decline in positive momentum, indicating that the bulls are no longer as influential as they once were. Looking at the RSI, we can see it's moving lower, suggesting the price bias is to the downside. While we continue to hold below these two simple moving averages, like the recent downward trend will continue. A move lower from here could see it retest the recent low of 36.00. And then going below that, we could be heading down towards 35.90, 35.10. And then if we do head to those levels, 35.90 and 35.80 rather, 35.90, 35.80. If we do go to those levels, we'd then be printing 2-year lows. And then, of course, that'll be quite a big headline. And when people start to see headlines like, oh, the S&P 500 falls to a 2-year low, that adds to the overall bearish sentiment. But keep in mind, markets don't move in straight lines. Straight lines is the old adage. Look at the price action we've seen here in the past few weeks. We saw the market fell to a 21-month low. It had a rebound. The market appears to be turning lower on itself. So even if you've missed the sell the rally opportunity here, it's quite possible the market could fall down to, say, for example, 35.90, 35.80, and then rebound, perhaps up towards 36.00 before moving lower again. What's a common tactic by traders is to study previous price action and then use that as a predictor for future price action. So we saw the market move aggressively lower here. It fell to kind of a year low, a 1.5 year low. It had a rebound, it sold off. It had a rebound here. The rebound failed to clear the previous peak. It moved aggressively lower. Had a bit of a rebound here, only to pull back. Had a rebound here, didn't really last, and before it moved lower again. So kind of like imagine, use like I said, some traders will use previous price action to try and gauge what's going to happen in the future. On the flip side, if we do see a rebound in price, and for example, if the 3600 level, 3600 level holds, that could be an early indication that a larger rebound is in the offing. If we do have a large rally from here, where would I be looking to? Well, first and foremost, I'd be looking towards this moving average here, the 50-period moving average. It's sort of acted as resistance here, not perfectly, but if you follow it around, you can see it acted as a consolidation zone here, and a resistance point here, and a support point here. So what I often say is, if a metric has been of importance in the past, it makes it more likely to be of importance in the future. So if we do see a large rally in the US 500 from here, where can we target? I'm looking up toward this moving average here, which comes into play at 37.38. And then if you go beyond that, I'll be looking up toward this peak here, which comes into play in around 3,800 and then 38.15. These are the areas I'll be watching out for. To be honest, it's only really if we can reclaim this peak here at 39.07, well, then I look to kind of change my attitude, and maybe I think perhaps the recent bearish trend has come to an end, and then we could be looking at potentially going higher. Are there any markets that you want me to take a look at? Because I'm happy to take a look at whatever markets you want me to have a look at. So I'll run through the UK 100. I'll have a look at oil, and then I'll throw things open to whatever markets you want me to analyze. So looking now at the UK 100, the FTSE 100, it's a fairly similar situation to what we've seen on other stock markets around in Europe or around the world, whereby we've seen a rising government bond yields. With that, there's been a move to the downside in the domestic stock market. That there are concerns that the UK government might struggle to pay its debt, and therefore British stocks are falling. To be honest, those concerns are very, very mild for the time being, but it kind of feels like we're in the early stages of that. But that just, it's a sort of thing which those fears could easily fade in the next couple of weeks. But nonetheless, we saw this week at the UK 100. I think to this lowest level, it's in February this year. I think it was 1967. Just looking out for potential areas of resistance to the upside. So if you take a look at the price action recently on the UK 100, it fell back to a level last seen in February of this year. So we're talking, back to 7-month lows were recorded this week. So it goes to show you how kind of bearish sentiment is. Also, keep in mind, a moment ago I talked about the S&P 500 over in the US. That fell to its lowest level in 21 months. There's a common theme here developing. We're seeing multi-month lows in stock markets. One of the areas of technical analysis I'm really subscribed to is Dow theory. And with Dow theory, one of the tenets of Dow theory is that the averages must confirm each other. And what that essentially means is markets that are quite similar, in theory, should move in the same direction at the same time by roughly the same amount. So if you're thinking to yourself, oh, UK 100, the FTSE 100 looks quite weak, I think it's going to fall further from here. I look at the chart, it appears to be quite bearish. It's recently hit a 7-month low. The rebounds it has aren't that big. I suspect that they won't last very long. It is worth your while taking a look at other stock markets around the world to see what they're doing. If they're also falling, and if their price action is quite similar, then you can become more confident in your original view. But obviously, there are no guarantees. Now, we've recently seen the UK 100 fall to a 7-month low. That really speaks to how bearish market sentiment is. We can see here that we had the rally that we saw here wasn't even that impressive. The peak in this rally didn't even manage to retest these peaks along here, and it's already handed back most of those gains that were accumulated in that rally, in that rebound. We're moving lower yet again. Taking a look at the RSI, it's going to roll over on itself. It's moving lower, indicating the price bias into the downside. Looking at the MACD indicator, momentum has swung from positive territory to negative territory, implying that the bears are now in control. If we do see this broad bearish trend continue, where can we target? Well, I'm looking towards 68.00, and then below that 67.00. These are the areas I'd watch out for potential support. On the flip side of the coin, if we do see a rally from here, if the market can manage to hold above this zone here at 68.25, that could be an early indication that we're going to see a bit of a bounce back. A rally from here could see it retest 69.67, and a break beyond that could see a target 70.48, and then going beyond that, we could be up towards 70.80. Coming on now to US oil. So once again, any markets that you want me to take a look at, feel free to just type away in the chat box. What I'll look to do is I'll cover US oil, WTI, and if there are no markets you want me to look at, I'll look to wrap things up. So any markets you want me to analyze and discuss, feel free to just type away in the chat box. I'm more than happy to do it. So the oil market, like other markets around the world, has come under a bit of pressure recently. Earlier this week, it fell to its lowest level since January. So we're talking about an 8-month low or 9-month low was set on the oil market, which really kind of speaks to how bearish the recent downward trend has been. Why is this? Well, there are concerns the global economy is slowing down. There are concerns about high levels of inflation eating away at consumers' pay packet, and if inflation remains too high for too long, that chips away at consumers' ability to go out and spend money. Therefore, that leads to a drop-off in demand. What's also going on, because of the high inflation, we've seen multiple central banks carry out multiple interest rate hikes as a way of trying to tame inflation. When central banks increase interest rates, they're increasing the cost of borrowing. Therefore, they're adding to the inflation problem, and they're contributing to demand being chipped away at. So it takes several months for rate hikes to properly trickle down to the economy. But what the financial markets do is they're always looking several months in advance. So they're essentially pricing in weakened demand for oil today, 6 months from now, but today. So during the week, we saw oil fall to its lowest level since January of this year, which really speaks to how bearish the market is. That being said, it has enjoyed a pretty decent rebound. We've managed to clear these peaks along here. We've traded above these two simple moving averages. Looking at the RSI, it's moving higher. Looking at the MACD indicator, momentum's in positive territory, although positive momentum is ever so slightly in decline itself, which to my mind indicates that the bears are in control, but perhaps they're losing a bit of influence, perhaps. So if US oil manages to hold above these two simple moving averages, that could be their indication that the short-term rebound will continue. A rally from here could see it encounter resistance from this simple moving average here, the 100-day moving average. And just to remind you once again, I'm looking at the 4-hour time frame. So looking at we can notice how the 100-period moving average acted nicely as resistance here in mid-September. It acted as resistance here, it acted as support here, it acted as resistance here and support here. Once again, if a metric has been of importance in the past, it makes it more likely to be of importance in the future, but there are no guarantees. And what I mean by that is, traders out there will be looking at, how's this acted as support or resistance before? Because if it has acted as support and resistance before, there's an increased likelihood that will act as support or resistance again. Looking at that moving average, it comes into play in around 83.41, and a break beyond that could see it toward this zone here around 84.50, and then beyond that up toward this peak here around 85.75. Now, even though the shorter term trend for US oil is higher, let's not forget the much longer term trend for US oil is lower. So if we do see a move to the downside, where can we target? Well, I'd be looking down towards this zone here. If you look at this low here, sort of coincides with this peak here and this peak here. And that comes into play roughly around 79 spot 30 thereabouts. So keep an eye for 79.30 to the downside. Then I'd be looking down toward this low here around 76 spot 24. And the big one to watch out for will be the recent multi-month low in around just north of 76.00. And then, of course, if you go below that, we'd then be back down to levels last seen, possibly even in December last year. Then we get printing new multi-low headlines, and that in itself would be an indicator or a kind of quite a strong signal about how bearish sentiment is. Go below that, and then we're looking down towards 75 and then 74 below that. I'm just conscious now that I've been speaking for about half an hour and no one's asked any questions, or no one's asked any are there any markets you want me to take a look at. So if there are no questions and there are no markets you want me to analyze, that's fine. I'll look to wrap things up. But if there are any markets you do want me to take a look at, feel free to type away in the chat box now. Just typing in the chat box now once again, any markets you want me to take a look at, because if not, I will look to wrap things up. So I'm going to look to wrap things up now, seeing as no one asked any questions, or nobody asked me to analyze any of the markets. I'm sad to say that today is going to be my last Scan the Markets webinar with me, David Madden, as I'm actually finishing up. I'm finishing up working for Equity Capital next week, in the middle of next week. So therefore, this sadly will be my last stint with the FX Basic clients with the Scan the Markets webinar. So I just want to say a big shout out for those, and thank you for all of the regulars who attended my webinar, and also a shout out and a thank you for those who joined my webinar for the first time in this session. I really enjoyed my time at Equity Capital. I've really enjoyed my time chatting and interacting with my colleagues in FX Pesa, and also, of course, I've really enjoyed my time chatting and interacting with the clients of FX Pesa too. So I wish you all the best. I wish FX Pesa and Equity Capital all the best as well. And I look to sign off there. So everyone, thank you very much. Good night and good luck. Thank you very much. I appreciate the comments. I really do. It means a lot. Thank you, everyone. See ya.